This video is the fourth in a set of videos related to project management. With this video, we begin to address the main concepts related to assessing the economic viability of the project. In this presentation, we will talk about risk and the time value of money. This presentation is organized in two different parts. In the first part, we will talk about investment profitability measures. And in the second part, we present concepts related to risk and the time value of money. So let's start by the definition of the return on investment. So this parameter is very simple to evaluate. It does not take into account the duration of the project, and it's simply obtained by dividing the profit by the initial investment. To illustrate this definition, let's look to a very simple example. So let's assume that we are planning to put some money in a bank account, for example, 1,000 euros, and we are planning to obtain after 2 years the amount 1,400 euros. So the profit, of course, is different between these two parameters, that is 400 euros. And then the return on investment is simply dividing the profit, 400 euros, by the initial amount, 1,000 euros, that is 40%. So let's consider now the concept of effective rate of return. This concept is important when we have the possibility of redeem the money before the end of the investment, which we call the maturity of the investment. So in the previous example, it was 2 years. So what we would like to consider now is the possibility of redeeming our money after 1 year. What we would like to know is what is the amount that we can collect after 1 year, if we decide to do so. So to answer this question, we need to model how the amount of money in our account changes through time. So we know that initially, when we make the investment, the initial amount in our account is equal to the initial investment, that is 1,000 euros. Now we are going to say that after 1 year, we will have an amount V1, which is equal to the previous amount, the original amount, that is V0, plus what we call the interest earned during the first year, which we represent by J1. And then we will say that in second year, we will have an amount V2, which we know that is 1,400 euros, but this amount is equal to what we had in the previous year, that is in V1, plus the interest earned in the second year, which we represent by J2. So we are considering these two possibilities that we represent in this figure. So the first possibility is investing the money in time equals 0 and collect it after 1 year, or the second possibility is investing this money in time equals 0 and collect it after 2 years. So let's see how we can evaluate the effective interest rate. So we are going to designate the effective interest rate by R, or by R with the subscript EF, which stands for effective. And as we saw before, the interest is designated by J. And the interest, of course, represents the reward on capital. Since it is the reward on capital, the interest is, of course, a function of the capital that was in the beginning of the period. So it is simply that amount multiplied by the effective rate. So we can say that the amount that we have in the end of a given year is equal to the amount that we have in the beginning of the year plus the interest earning during that year. So using this definition, we arrive to this expression, that is, the final amount is equal to the original amount multiplied by this factor 1 plus R. Now, applying this concept to our example, we can write for the end of first year, the amount is the what we get in the beginning of the year, that is V0, multiplied by 1 plus R. We can say the same for the amount that we have in the end of the second year. It's what we have in the beginning of that year multiplied by this factor 1 plus R. That is, we can relate, of course, V2 and V0 through this expression, in which the original amount is multiplied 2 times by the factor 1 plus R. And through this expression, we can solve it to extract the value of the effective rate, because we know the value of V2 and we know the value of V0. So the effective rate is simply this ratio, which is 1.4 to the power 1 divided by 2, and then we subtract by 1, and we get 18%. What is interesting to note is that this amount is lower than half the return on investment, because as we saw before, the return on investment was 40%, but now we don't get 20% for the effective rate. Is lower, because in the effective rate we are earning interest on interest. So we have interest in the first year, and that interest which is added to our account will earn also interest by the end of the second year. Now, since we have the value of the interest rate, now using this expression, we can extract the value of V1 if we intend to redeem our money after 1 year, which of course, taking in account the value of V0 and 1 plus the interest rate, give us this amount, 1,183.2 euros. Now we want to analyze the possibility of redeem our money with more frequency. For example, in the end of each month. To do that, we need to introduce the concept of nominal rate of return. To illustrate this concept, we are going to use the same example. That is, we assume that our intention is to make an initial investment of 1,000 euros, and after 2 years, that is 24 months, we want to collect 1,400 euros. So the nominal rate of return in this case is called nominal monthly capitalization rate, is defined or is represented by RM or R12, because the year is divided in 12 parts. But this is what we call an annualized rate of return. That is, it is a monthly rate multiplied by 12. That means that the effective rate for 1 month is in fact R12 divided by 12. So we need to define how or characterize the interest earned in a given month. So the interest earned in a given month is of course a function of the amount that was in the beginning of that month, that is, we represent it here by VM-1, and multiplied by the rate of 1 month, which we saw that is R12 divided by 12. So the amount that we will have in the end of the month is the amount that we have in the beginning of the month plus the interest earned in that month. So combining these two expressions, we arrive to this result, which says that the value in the end of the month is equal to the value in the beginning of the month multiplied by this factor 1 plus the rate of 1 month. Now we can also in this case relate the final value with the original value using the effective rate of 1 month. So in this case we have 24 capitalization, that is, in the end of each month we evaluate the interest, and that amount is accumulated to the value that is in our account. So we are going to obtain the final value through the original value, multiplying it by 24 times this factor 1 plus the rate of 1 month. Of course, that we already evaluated the effective rate, and we can relate the final value through and the original value through the effective rate through this expression. So we can combine these two expressions in order to relate the effective rate with the nominal rate R12. So we can solve this expression in order to extract the effective rate of 1 month, that is R12 divided by 12, which is 1 plus the effective rate of 1 year, to the power 1 divided by 12, and we get this amount, 1.412% a month. Now, this is the effective rate of 1 month, which we can analyze multiplying by 12 to obtain the nominal rate with capitalization with monthly capitalization, which is in this case we obtained the value of 16.94%, which of course is lower than the effective rate, but it's lower because in this situation, in the situation of monthly capitalization, we can say that the money is working more. So in the end of each month, the money produces results, and these results will also produce results which accumulate to the original amount. So we need a lower rate to arrive to the same final value. So with the evaluation of the nominal rate, we can now illustrate how we can use it, for example, to evaluate the amount that we have in our account or the amount that we can redeem after 5 months. So we have the original amount, so we have this factor that corresponds to the or that is 1 plus the rate of 1 month, and of course after 5 months we accumulated 5 capitalizations, so we just need to have this factor, which is 1 plus 0.14 to the power 5 multiplied by the original amount, and you get this amount, 1,072.6 euros. Nevertheless, we can also obtain this result using the effective rate, because this factor here, we can of course see that it is related with the effective rate. So we can use this expression here or this expression here. What is interesting to notice here is that we have here the rate in months, we have here the time in months, we have here the rate in years, and we have here the time in years. 5 divided by 12 is the time corresponding to 5 months measured in years. So of course, using the data that we already have, we arrive to the same amount. So let's now consider the case of continuous capitalization rate of return. So this case is similar to the previous one, in which we decrease the interval between capitalizations. So in the previous example, we consider after 1 month or each month. Now we can consider in the end of each week, or decreasing more in the end of each day, or in the end of each hour, or in the end of each minute, or whatever. So in the limit, we have a very small interval, which is, of course, leads us to the concept of continuous capitalization rate, because this interval is as small as we want. Okay. Now, the situation is similar to what we saw before. So at a given point in time, t, we have this amount in our account, vt. And after a small time interval, that is 1 time is t plus dt, we will have a change. We will read vt plus dt in our account, which of course relates with the original amount plus a deviation of value, which of course we expect that is positive, because we are expecting to earn interest during this time interval, which we represent by j dt. Okay, so what we have here in this figure, we can also write here in this expression. So we have the amount after a small time change is the amount in the beginning of that time interval plus the small variation, which of course is equal to what we have here, the interest. Now, but this interest that was earned is a function of the original amount, and it is obtained by multiplying this original amount by the rate corresponding to this small interval, which of course, if we have the annualized rate RC, we need to obtain the rate for this time period, we need to multiply the annualized rate by dt, which is the time in years, measured in years corresponding to dt. So in this way, we can represent dvt as the original amount. So the change that we get is the original amount multiplied by this factor, the continuous rate multiplied by the time interval, dt. Now we can solve this differential equation by separating variables. That is, we can put dvt divided by vt in first hand side, and then we get dt in second hand side. We can then integrate. So in first hand side, the value goes from v0 to v2 after 2 years. The time in the second hand side goes from 0 to time equal to 2 years. And of course, solving this, we get this expression, which we can solve in order to obtain RC. Okay, so we can obtain RC by this expression, which involves the logarithmic of v2 divided by v0, and we get 16.82%. So this is a value that is similar to the nominal rate that we saw before, and it is 16.9%. And of course, that as before, we can relate the continuous capitalization rate with effective rate, because we know that the final value is related with the original value. If we use the continuous rate, we can use this expression here to obtain this one that involves the exponential and the time and the continuous rate, or we can use this relation that comes from the effective rate. That is, the final value is the original one multiplied by this factor 1 plus r 2 times. So we can, of course, using these two expressions to arrive to these relations. Now, let's illustrate the difference, what's happening differently when we have continuous capitalization, for example, and monthly capitalization. So we are going to consider the same examples that we saw before. That is, we want to evaluate the amount of money that will be in our account after 5 months. So in the case of continuous capitalization, we can evaluate that amount through this expression that involves the original amount and the exponential of the continuous rate multiplied by the time in years. So we have it here. So the value after 5 months is the original amount, that is 1,000 euros, that multiplies the exponential of the continuous rate, that is 16.82%, and the time in years, that is 5 divided by 12. That is, we obtain 1,072.6 euros. Well, but this is the same that we obtained before when we consider the monthly capitalization that is years. So this is exactly the same amount. Okay. Now, what is the difference? Well, we can illustrate the difference if, for example, we intend to redeem our money 5 months less 1 day. So in the case of the continuous capitalization, that is, we have a deal with the bank in which our account is updated continuously, what we will extract is obtained from this expression. So it's similar to this one, but the time now is 1 day less. but in years. So this factor here is now replaced by 5 divided by 12 less 1 divided by 365. So we obtain a small change, just 50 cents. But when we go to the monthly capitalization, we in the monthly agreement, in monthly capitalization agreement, what we have is our account is updated once a month. So one day before the end of the fifth month, we don't have yet there the fifth capitalization. So if we decide to extract our money at that point in time, what we will collect is what was there in the end of month 4. Okay, so we haven't there yet the 50 capitalization. So what we will get is lower. Okay, relatively lower. So that's the difference. And now we move on to the second part. Let's start with the relation between return and risk. To illustrate this relation, we are going to use a study example. In this case, we are going to consider a very simple game in which we roll a dice, and that is a 6-sided dice. And in each move, we have to put on the table 50 euros. If the outcome is positive for us, that is, if the outcome is 5 or 6, we will receive 153 euros. Otherwise, we will lose the money that we put on the table. So when faced with a situation like this, any investor will like to have the answer previously before deciding to these two questions. Is it advantageous to play this game or not? And if it is advantageous to play this game, are we willing to play the game or not? And what we mean by this is that are we willing to support the losses if we play this game? Okay, so to answer these two questions, we may start by evaluating first what we call the probabilities of winning and the probability of losing. So the probability of winning, that is which we designate here by an up movement, is the probability of the outcome is the set in which we win. That is, the probability of the outcome is 5 or 6. Well, there are two possibilities in 6. That is 1/3. So the probability of winning is 1/3. Of course, that the probability of losing is 1 less 1/3. That is 2/3. So the conclusion is that the probability of winning is much lower than the probability of losing. So most of the investors will not play this game due simply to this data. Okay, now but this introduces us the concept of risk aversion, because many investors, although the probability of losing is higher, are willing to play this game. Okay, so this is why we need to analyze this example in more detail. So let's analyze this problem in more detail. To do this, we are going to start by evaluating the expected value of the profit of playing this game. Well, we make a profit if the outcome is 5 or 6. In that case, the profit that we designate here by LU is the outcome, that is CU, which is 153 euros, less the investment, that is the money that we put on the table, that is the 50 euros. That is, the profit in this situation is 103 euros. Well, if the outcome is different from this set, that is, if it is 1, 2, 3, or 4, we will lose. And the profit in that situation is, of course, the outcome that we get, which is 0, and what we put on the table, which is the 50 euros. That is, we have a loss of 50 euros. Okay. Now, the expected profit is these two possibilities multiplied by the respective probabilities. This is what we represent here. That is, we make a profit of 103 euros with the probability of 1/3, and we make a loss of 50 euros with the probability of 2/3. And the result is 1 euro. Well, based on the expected value, we cannot say that it is not advantageous to play this game. Now, based on this result, that is the expected value of the profit is positive, we may have two different situations. We may have a situation in which we can play once or a few times, and in that case, in fact, is not advantageous to play, because if the money that we are going to lose is important for other investments or for other expenses, you should not play, because the probability of losing that money is higher than the probability of making a profit. But if you have to play many times, or if you can play this game many times, you should play the game. Because as we illustrate here in this table, so this table shows all the outcomes. And for example, if you have the chance to play this game 6 times, and if the outcomes that you get is exactly what the probabilities give, you will make a profit, because you will make an investment of 300 euros. So in each of the 6 moves, you have to put on the table 50 euros. So the total is 300 euros. You will lose 4 times. So you will not get nothing for 4 times, but in the other 2 you will get 306 euros. So you make a profit of 6 euros. Of course, that you may argue that there is no guarantee that if you play 6 games or 6 moves, that the outcome will be according to the statistics. Nevertheless, if you play 100 moves or 1,000, well, it will not deviate. The result will not deviate much from this ratio. So in that case, you conclude that this is willing to play. And this is what the project manager must do. So he must make always decisions based on probabilities. He does know exactly what will be the outcome, but the criteria is that if the expected value is higher than 0, then he must play the game. Because if he always make decisions based on this criteria, and since he has to make many decisions, the outcome, the average of the outcome of those decisions will be positive. So this is the logic that is behind this decision criteria. Now, looking to what is the possible behavior of many investors that are faced with a situation like that, we can say that many of them are right. And they are right because, for example, many of them are not able to play that game enough times so that the results will be according to the statistics. And of course, if they can only play a few moves, they know that the probability of losing is higher than the probability of winning. So they should not play. So, and that's correct. And we can model that kind of behavior introducing what we call an utility function. An utility function is essentially a function that applied to a certain outcome will have a decreased derivative when the outcome increases. So this is what we have represented here by this function. The outcome is x, and the result will be x to a power, which is 1 divided by alpha, in which alpha is the degree of risk aversion. Applying this to the example that we have saw before, and considering that the risk aversion factor is 1.2, we can say, for example, that when the investor put money on the table, that is, he are investing 50 euros, that has an utility for him that is 50 to the power 1 divided by 1.2. That is 26.05 euros. Now, what the investor must do is compare this with the utility of the expected outcome. So he has two possible outcomes. The outcome of success, in that case, you will get 153 euros, and the utility corresponding to this value is you must make this calculation. 153 to the power 1 divided by 1.2, it gives us 66.16 euros. Nevertheless, the other outcome, you will get nothing. And in that case, of course, the utility is 0. And the expected utility of these two possible outcomes, of course, is these outcomes multiplied by the respective probabilities. That is, this outcome 66.16 is multiplied by 1/3, and the other outcome by 2/3, but it is 0. So the expected utility of the outcome is lower than the utility of the original investment. So in this situation, you should not invest. So with this level of risk aversion, this investor will not enter this game. So we need now to see how this can be used to evaluate how the investors and how the projects are evaluated. Now, assuming that this investor, or this kind of investors with this degree of risk aversion, if we want to attract these investors to our game, let's assume that our game is a business, and we would like to attract them to our business. What can we do to make them play? Of course, that we cannot change the expected outcome. So this is the expected outcome of the utility of playing. What we can do is, in fact, changing this. So we can, of course, changing the initial investment. That is, instead of investment 15, we can ask them a lower value, so that this result is lower than this one. So to solve this, we just need to solve this equation that we represent here. So this is the amount that we are looking for. And when we solve this equation, we get this amount. And so instead of 50 euros, what we need to ask to this investor to play our game is 41 euros. But when we look to what is the expected profit for this player, if we ask him to invest 41 euros instead of 50, in fact, it's much higher. Instead of €1, is expected expected profit is €10, because this is the result if he plays. This is what he invests. This is his profit in the case of winning with this probability, and this is what he will lose with this probability. So this is its expected profit. So the conclusion is that with the risk aversion, to attract the investors, we need to lower the initial investment that we require to them. Now, the conclusions that we make before can also be obtained if we consider that investors, in fact, in most of the times, they look to the returns on the investment. So, in the case of we don't consider the risk aversion, the expected outcome of our decisions is the outcome in which we win, that is with probability 1/3, and outcome of if we lose with probability 2/3, that is €51. And with this information, we can evaluate the expected return on our decision. That is, the expected return is the expected outcome less the investment, which is the expected profit divided by the investment. Of course, that we already saw that the expected profit was €1. That is the difference between 51 and 50, which divided by 50 gives us an expected return on investment of 2%. If we consider an investor with the risk aversion that we would like to attract to our game, well, the expected outcome is the same, is the €51, but the investment required in that case instead of 50 is 41. That is, the expected profit is €10 instead of 1. Well, when we divide by the investment required, we arrive to 24%. That is, it's much higher. This means that dealing with investors that are risk averse requires to offer them much higher expected return on investment. Now we are going to look to the concept of time value of money, but we are going to illustrate this concept taking in account the relation between risk and reward that we saw before. That is, we saw that higher risk translates in higher risk aversion factors, which in turn translates in lower investment to attract the investor to the game, which in turn translates in offering to the investor higher expected returns to enter the game. So let's start by illustrating this concept, the concept of the time value of money, considering a risk, what we call a risk-free investment. In this kind of analysis, it's usual to consider that the reward that we can obtain from a given investment, in this case, which we consider here is 10%, is equal to the cost of borrowing money, which we will consider in this second situation. Now, in this first situation that we are considering here, we are assuming that we want to invest €1,000 now. Okay, and at this rate of reward, we are expecting to collect 1 year from now 1,100 euros. So we can translate these ideas with these expressions. So we say that the future value of this investment of I0 is C1. This is what we are going to collect. This is what we have here. Okay, but we already saw in the previous lecture that what we will receive is equal to what we put now multiplied by 1 plus the reward rate or the effective rate. So we can say that the future value of a present amount is that amount multiplied by the factor 1 plus r. Okay, that is what we have here. Now, considering the case of borrowing money, suppose that we need to borrow 1,000 euros to buy something, a bicycle, for example, and the bank asks us this cost of capital. That this is what we must. This is the reward that we must give to the bank for them to give us the money to use now. This means that, and if in the end what we will have to pay 1 year from now, this is what we will have to pay to the bank. Okay. Now, this is what we collect now, and this is what we will have to pay. So we can say that C0 is the present value of C1. That is the present value of what we will have to pay in the future. Of course, that we already saw, even if in this case that C1 and C0 are related by this factor. Now, but in this case, we can say that the present value of C1 is a cash flow in the future, or an amount that we have to pay in the future. That is what the equivalent that we receive today for that amount that we will have to pay in the future. It's obtained by that amount, and now we divide by 1 plus r. That is 1,000 euros. That is, we can have here in time 0 and here in time 1. We have here the present value, and we have here the future value. Okay. Now, if we invest in time 0, the amount that we get will be multiplied by 1 plus r. But if we want to borrow money, in the future we will have to pay the future value, and now we will collect the present value. But in that case, the future value that we have in the future, that we have to pay in the future, must be divided by 1 plus this factor to obtain what we will get now. So the equivalent today is multiplied by 1 plus r to obtain the equivalent in 1 year from now. And the equivalent in the future will be divided by this same factor, that is multiplied by 1 divided by 1 plus r, to obtain the equivalent today. So this is the definition of future value and present value, taking in account the opportunity cost of capital, which in this case, since there is no risk, is this rate, which is the same for investing and borrowing. Now we are going to introduce the concept of net present value. The net present value is simple. The present value of a future outcome less the required initial investment. So considering the previous example that we saw before, we plan to invest 1,000 euros, and we plan to be rewarded at this rate, that is 10%. So this is the expected future outcome, or the receiving that we are expecting, 1,100 euros. So this is what we get. The present value of C1 we saw before is C1 divided by 1 plus R. So when we try to evaluate this quantity, the net present value, we get this result. That is, the initial investment is 1,000 euros. Now C1 divided by 1 plus R is 1,100 divided by 1.1. Well, the result gives 0. Well, this is a very simple result. Nevertheless, this result translates the most important principle in modern finance, which of course is the basis of evaluating any investment, any project, any asset. It essentially translates the idea that the value of the investment, that is what we are putting in the project, is equal to the present value of future benefits. Well, and we of course are doing this considering that there are no risk, because we are considering the case of the risk-free investment. Nevertheless, this idea is extended even if we have investments with risk, as we will see in the next examples. Now let's consider the situation in which we have risk. To analyze this situation, we have another example in which we would like to invest 900 euros, but we have two possible outcomes. That is, the result of this investment can be 900 euros 1 year from now, or 1,300 euros. And these two outcomes have the same probability, that is 0.5. Well, we can start by analyzing this investment by evaluating the expected outcome. So the expected outcome is simply the two possible outcomes multiplied by the respective probabilities, as we show here. That is, the expected outcome is 1,100 euros. Okay. Now, and the expected reward is the expected profit, that is the expected outcome less the investment, which we show here, divided by the investment. That is, the expected reward is 22.2%. Nevertheless, we don't, in terms of decision about the viability of the project, we don't decide based on this information. We decide based on this. We need to evaluate the net present value. So we need to see if this is a fair deal or if it is not. And we saw previously the fair deal is the one that corresponds to have a net present value equal to 0. Okay, so of course that in this case, when there is a risk, we need to perform a statistical analysis. And what we are going to do is that we are going to evaluate the net present value as we represent here, taking in account what we call the opportunity cost of capital. This R that is here. And this opportunity cost of capital is evaluated on a statistical basis, and it reflects the risk associated to projects similar to the one that I'm considering. So this is what I'm going to use. And then my decision depends what the statistics tells me. For example, and we are going, of course, to analyze different situations. The first one is that let's assume that the opportunity cost of capital, that is the reward that other projects with the same level of risk or uncertainty that are there, okay, is of course is this value. In that case, the opportunity cost of capital is 22.2%, and if I apply my definition of the net present value, that is, we divide the expected value of the outcome by the 1 plus the discount rate, that is the opportunity cost of capital, and then if you subtract the investment, this is the calculation that we are doing here. That is, we consider the expected value of the outcome. We divide by 1 plus the opportunity cost of capital, and then we subtract the investment, and you get 0, of course. That means that if the opportunity cost of capital, that is, if the reward of other projects with the same level of risk is in fact 22.2%, then this is a fair deal. This is what it means. It is a fair deal. Okay. Now let's consider the situation in which the opportunity cost of capital, that is the reward that equivalent projects for the same level of risk on average give, is 15%. So in this situation, we get the net present a positive net present value. That is, we consider the initial investment, we consider the expected outcome, we divide by 1 plus the opportunity cost of capital, and we get a positive result that is greater than 0. That is net present value greater than 0. What is the meaning of this number? Of course, that this indicates that this is a good project, but essentially it indicates that we are buying this project for a price that is lower than the fair price, and this is the discount in the price that we are getting. So essentially, this represents my potential gain if I decided to sell immediately this project. So I can buy it by this amount, and I can sell it by this amount plus 6.52. So this is the new price by which I can sell my project, because if this is the fair reward for this kind of project, I can reevaluate my project, because the outcome is fixed. This is given by the market conditions. Well, and I have here the new price. I solve this. This is the fair condition, the fair deal. The fair deal is having a net present value equal to 0. So in this situation, I have the net present value equal to 0 with the new price. For another investor, it's higher. So I can buy it by this amount, and I can sell it by this amount. So I can profit immediately this amount. Okay, so this is the logical. Although there is uncertainty involved, okay, the net present value is a value that is reported to time now, and it represents a potential profit that we can make immediately. Now, this is the last case. So in this case, we assume that the opportunity cost of capital is 30%. So in this case, when we evaluate the net present value, that is, we take in account the initial investment, we take in account the expected result, and when we divide by 1 plus the opportunity cost of capital, we arrive to a negative value. Okay, so this indicates that this is not a good project. Now we must clarify why this is not a good project. This is not a good project, although we saw that the return on investment of this project was 22.2%. Well, if we look to this value only, it is a good reward. So it doesn't mean that we are going to lose money in this project. Why are we saying that it's not a good project? It's not a good project because we are assuming that there are similar projects out there with the same level of risk that instead of this give us 30%. So we are not going to invest in a project that give us that provides us 22.2% while we have alternatives that give us 30%. That's the logic. Okay? In a market context, if I buy this project by this amount of money, and if I'm not able to wait 1 year to get this result, and if I have to sell it immediately, I will lose money, because if I need to transact this project, I will have to sell it by a lower amount. By a lower amount. So this is the original amount that I paid, 900 euros. Okay. Now, since the net present value is negative, I will have to sell it by this amount if I need to sell it immediately. So this is a potential loss if I need for somehow to get rid of this project. For example, I can decide to sell this project if I found a better opportunity, or if somehow something went wrong and I need the money. Okay, so that's the idea. It doesn't say that it's not a profitable project. It says that it's not the best decision that I can make. So this is why it's a bad project if the opportunity cost of capital is 30%. And we come to the end of this video. I thank you for your attention, and I count on you for the next video.